Welcome to the latest Iraqi Dinar. As we gather to explore the shifting currents of global finance, there's a quiet storm brewing in Southeast Asia, one that's gaining momentum beneath the surface of mainstream headlines. The country at the center of this transformation is Vietnam, and its trajectory suggests not just progress, but a possible reshaping of the financial order in the region. Over the past 2 years, Vietnam has made a strategic commitment to becoming a digitally empowered economy, with a focus on overhauling how money is created, moved, and accounted for within its borders. The transition to a cashless society is not a trend. It is a deliberate, structured initiative aimed at modernizing Vietnam's financial system. This includes widespread adoption of mobile payment applications, increased access to digital banking in rural and underserved areas, and robust government support for integrating digital identity systems into financial services. These steps are not only about convenience or inclusion, they represent a sophisticated preparatory phase for something much larger. Countries that aim to revalue or restructure their currency must first build resilient financial architecture. Why? Because revaluation, particularly in emerging markets, brings heightened capital movement, foreign interest, and scrutiny. Without mechanisms to track financial flows, prevent fraud, detect market manipulation, and ensure regulatory compliance, such a shift could backfire. Vietnam's authorities seem acutely aware of this. They're not only investing in payment infrastructure and cybersecurity, but also working closely with financial regulators and multilateral partners to standardize reporting and transparency practices. These steps send a strong signal. Vietnam is getting ready, but digital modernization is only part of the picture. Vietnam is increasingly positioning itself as a regional financial technology hub. Major players in the Asian Fintech world, including firms from Japan, Singapore, South Korea, and even China, are funneling resources into Vietnam's technology sector. These companies are not just building apps or offering services, they are embedding themselves into Vietnam's financial DNA. They're training local talent, setting up innovation labs, and building bridges between traditional banking and decentralized finance ecosystems. For investors, this signals a mature market in the making, one that is being structurally prepared for deeper integration into global financial systems. Simultaneously, Vietnam has been strengthening its ties with BRICS nations: Brazil, Russia, India, China, and South Africa. While Vietnam is not yet a formal member, its participation in multilateral forums, working groups, and currency discussions with BRICS central banks has grown more frequent and more serious. One of the key topics being explored is the creation of a new international currency, potentially backed by gold, oil, or other sovereign assets rather than fiat or debt. This would be a historic shift, moving away from the traditional U.S. dollar-dominated system toward a multi-asset, multipolar financial reality. Vietnam's inclusion in these discussions is no accident. The country possesses several strategic advantages: a geopolitical location along critical maritime trade routes, political independence from major global powers, growing export capabilities, and substantial natural resources. These characteristics make Vietnam an ideal bridge between East and West, and a viable candidate to participate in or benefit from a new monetary system. While many are familiar with Vietnam's recent rise as a tourist destination, fewer are paying attention to what comes after the tour groups leave. Increasingly, visitors, especially from South Korea, Japan, the U.S., and Australia, are investing in the country. They're purchasing real estate, acquiring stakes in local companies, forming joint ventures, and setting up long-term residency. In some areas, entire new cities and industrial parks are being funded by this foreign capital. This is not a tourism boom, it is a capital migration. To attract and retain this investment, Vietnam has offered generous tax incentives, eased restrictions on foreign ownership, and simplified business licensing processes. These reforms have helped to supercharge foreign direct investment, FDI. This influx of external capital, combined with controlled inflation, steady economic growth, and rising foreign reserves, creates a textbook environment for a potential currency revaluation. Economists have long observed that when developing nations achieve sustained capital inflows and a robust export base, their currencies tend to adjust upward to reflect the new reality. Adding to the intrigue is the unusual behavior of Middle Eastern central banks, particularly those from oil-rich Gulf nations. These entities are typically conservative investors, favoring stable U.S. treasuries or European bonds. Yet recently, there's been a quiet but significant increase in their purchases of Vietnamese government bonds. This behavior suggests these institutions believe the dong is undervalued and likely to rise. They're buying in early ahead of the curve. Private banks in regional financial centers like Singapore, Hong Kong, and Dubai are also reacting. Behind closed doors, their wealth management divisions have begun offering exotic currency portfolios to elite clients. Portfolios that now include the Vietnamese Dong. On the surface, these banks maintain public neutrality, denying any shift in outlook. Internally, however, they are reallocating resources and quietly positioning their clients for a potential currency event. This is a pattern seen before. During the run-up to Iraq's currency revaluation, similar quiet moves were made by institutional players. Fund managers, hedge funds, and high-net-worth investors received discreet briefings and tailored products that reflected an anticipated shift, well before any public announcement was made. Reports are now surfacing that a select group of these entities have been advised to prepare for a dong revaluation within the next fiscal quarter. Meanwhile, in the retail world, U.S. credit unions and regional banks have reported an uptick in requests for exotic currency accounts, a space dominated by savvy retail investors and niche financial forums. These investors aren't acting on rumors. Many of them are following the same institutional breadcrumbs, watching the signs and acting accordingly. Back in Vietnam, the government is doing something else quietly profound, preparing its own population. Through national education campaigns, banking literacy initiatives, and government-backed tech upgrades, Vietnam is making sure that when the moment comes, its people won't be caught off guard. No country planning a serious revaluation drops the news overnight. It happens after months, sometimes years, of behind-the-scenes preparation, soft signaling, and public education. Vietnam is following that script. Internationally, there is growing evidence of global coordination. Trade deals are being adjusted. Debt restructuring agreements are being finalized. Oversight teams from the IMF and World Bank are cycling through Vietnamese institutions. These are not routine check-ins. They are deep dives into financial readiness. Even the IMF's public reports, though written in bureaucratic language, have started using technical phrases that signal structural change. Terms like monetary realignment, currency balance recalibration, and nominal anchor updates are being used with greater frequency. These are not phrases used by accident. They reflect deep internal discussions about value, exchange stability, and long-term monetary frameworks. Geopolitically, the balance of power in Asia is shifting. As tensions rise in the South China Sea, Vietnam has moved closer to the West, particularly to the United States. As U.S. corporations shift supply chains away from China, Vietnam has become a major beneficiary, both in manufacturing output and geopolitical capital. This increased alignment with the U.S. gives Vietnam stronger negotiating power, not just in trade, but also in currency diplomacy. All of this points to one conclusion: Vietnam is preparing for something historic. The country's strategy, economic indicators, policy shifts, and international alignments are not coincidental. They are coordinated, deliberate, and indicative of a potential currency event of major consequence. If the dong is revalued, the change will not be gradual. It will be sharp, fast, and irreversible, like most modern currency realignments. And those who are watching closely, who have been quietly positioning for months, maybe even years, will be ready. The Vietnamese Dong is no longer just a relic of a frontier market. It is becoming a modern asset, the product of disciplined planning, strategic alliances, and a changing world order. The pieces are falling into place. And when the move happens, it will not be a surprise to those who have been paying attention.